Well, the battered down financials led a rally on Wall Street yesterday, and more movement will come today with big financials reporting, as Robert just mentioned. We've already heard from J.P. Morgan, as you mentioned, it reported 54 cents a share. Of course, that beating estimates by 10 cents, and that's more good news for the sector that's coming off a very strong day on Wall Street. We're going to get results later today from Merrill Lynch, which netted $4.5 billion from selling its stake in the media concern Bloomberg, which we expect to confirm later on. For a look at where we should expect the financials to go from here, we're joined by banking analyst Dick Bove of Ladenburg Thalmann and Jason Schechter, managing director of the strategic communications firm Burson Marsteller. Good morning, gentlemen.
Morning.
Good morning.
All right, Dick, let me start out with you. Aside from Goldman Sachs, we had some good news coming out of Wells Fargo yesterday. One of the best rallies we've seen in the sector. Is the worst behind us, or was that somewhat of a short covering or relief rally?
No, I think that the worst is not behind us, and it wasn't just short covering. I think it was an understanding that people have if you will, gotten overly negative concerning the sector. In other words, bank stocks had been driven to prices which are below their liquidation value or below what it would cost to replicate any one of these companies. And the earnings reports that have come out from the 6 or 7 banks that have reported so far have been uniformly positive. In other words, what people are understanding is that banks can have significant loan losses or bad loans, and J.P. Morgan's numbers this morning show that their non-performing assets have jumped enormously, which would be perceived to be a very bad signal. But what they're beginning to understand is that the banks have many businesses and that those businesses contribute good revenues and earnings and that they can absorb these losses. That's the message that was lost over the past few months. That's the message that the market is learning now. So bank stocks are going to continue to rally very strongly for the next, I would say, certainly couple of weeks.
Okay, great. I'm going to come back to you because I know you issued a report talking a lot about non-performing assets, but I want to turn to Jason here for a second. One of the things I noticed you said it's critical that banks take measures right now to ensure that others don't define them.
That's right.
Because that's in essence what we're seeing. We're seeing these massive ripple effects. But the reality is if you're a CEO and you come out and you say, hey, I'm fine, you actually get punished in this market instead of getting rewarded. So how do you differentiate yourselves?
Yeah, I think that's absolutely right. And I think it's important to look at the fact that the market is really a measure of investor confidence. Well, so far, we have a lot of reason to be optimistic over the past day and this morning with J.P. Morgan's earnings. But don't forget the fact that U.S. Bancorp, M&T Bank, and others have reported fairly abysmal earnings so far this week. And so you can't forget the fact that the market has been driven by fear and uncertainty so far, notwithstanding the results from yesterday and this morning. And in that environment, everybody's looking for the next shoe to drop. And so it's really important for banks to recognize that and take measures to ensure that they're not letting others define their story.
Dick, let me turn back to you for a second. You issued a report this weekend that was called Who's Next? It got a lot of attention, would be to put it lightly, as I'm sure you know. And you had to come out and give a clarification. You basically looked at the banks in 2 different ways, in large measure looking at their non-performing assets. Explain to me why the clarification. Are we in such a strong and sensitive time that even for you, you've got to choose your words very carefully?
Yes, absolutely, and I think that the last comment is an indication of it. U.S. Bancorp's earnings were certainly not abysmal. They were only down 10%. The stock is down 33%. So basically what's happening is that every piece of information coming out of banking is overemphasized on the negative side. The company earned in the case of U.S. Bancorp, the company earned 53 cents a share, which is a pretty solid result, and yet the stock, has been down as if the company was in abysmal condition. I think that was the problem with the list. We put out a list, and the purpose of the list was to show that the vast majority of banks in the United States are in pretty good condition, are actually in excellent condition, and that there are about half a dozen, maybe 10, that should be on the danger list, of the top 107 banks in the country, which represent about 80% of the assets of the industry. But you can't say anything positive, as you just indicated. Anything you say that positive is viewed as a lie, and anything that you say that's positive as a company is rejected immediately. SunTrust says that their dividend is protected, and yet the stock jumps to an 11.5% yield before yesterday's rally. BB&T increases the dividends, indicates earnings are pretty good. The stock jumps to a 9.25% yield again before yesterday's rally.
Yeah.
Anything you say that negative, anything you make up, anything you want to put into the marketplace, which whether true or untrue is negative, the market gobbles up immediately. That's what's created the tremendous opportunity in these companies. That's why these stocks are dirt cheap, and that's why people should be